For more on the latest moves, let's welcome now John Augustine to talk more about these markets. John, you say looking ahead, there are some key areas we need to focus on, John. For investors, walk us through those. What do we need to be aware of in terms of, at least right now, what should be on our radar?
3 Ps, profits, so that starts the middle of the month, quarterly earnings season. Then policy, that's what we've been talking about today, specifically tariff policy. Then the third thing is productivity that we need to be talking about this year. Productivity, in our view, is what's going to drive profits because revenue growth is starting to slow down. Revenue growth is starting to slow down a little bit. So this year is the 3 Ps, but currently, you guys talked about it, Josh and Julie, it's about bond yields, the dollar, and now oil. Oil's kind of in this stealth rally now, up to $74 a barrel. That probably is going to dominate the first quarter of this year, we would say.
So a lot there to consider, but let's talk policy first of all, because that's sort of maybe most immediate with the latest tariff headlines back and forth. How is that going to affect your investment philosophy as you head throughout the year?
What's interesting about tariff policy, that's what we're kind of talking about, usually it helps small and mid caps. It's not doing that right now. Right. That was 8 years ago, before the Mag 7. So it's not doing that right now. But that's the first thing at our shop we used to think about. So now we think about more industries, and that's where the confusion comes in today. Is it going to be broad-based? Is it going to be targeted? One group says one thing, one group says another thing. So it's hard. I think the market, you can see that through the Dow this afternoon. What y'all talked about is having a tough time too.
And so what do you do about it though, John? As a market pro, as a CIO, your clients are asking, I'm sure, and you simply right now, there is conflicting headlines and all this uncertainty about tariffs, taxes, regulation, immigration. How do you try to think through that?
So first thing we think about is those profits, earnings season. So what's leading us to a bias of stocks over bonds right now is earnings season. And what earnings are expected to do this year, S&P 500 accelerate from last year. Earnings growth accelerate. So now the focus becomes earnings season. Are we going to get that 400 to 500 basis point beat in earnings from estimates? So that's the first thing. Second thing that's probably going to have longer legs this year is the concept of income. Income now may be able to smooth out volatility more than it has the last 10, 15 years. Because now I'm getting income from all three groups. I'm getting it from cash, I'm getting it from bonds, and I can get it from stocks if I want to diversify away from the Mag 7. So concept of income may be very helpful to investors this year.
And how should they incorporate that when they're thinking about income? In other words, they can diversify and still get income? Is that the message?
Yeah, so it depends on what kind of investor I am. If I'm accumulating, so I'm still accumulating my personal balance sheet, 4% doesn't mean a lot to me. But if I'm distributing, if I'm on that side of my personal balance sheet, 4% now means a lot to me because it used to be 0 a couple years ago. So it depends on where you are, your focus on income. But in our business, we've been missing 2 legs to the investment chair for 15 years, cash and bonds, and they're back. And we have to take that into consideration, obviously expecting somebody's outcome intent of their investment accounts.
Let me ask you, we talk a lot recently, you've heard all about the Santa Claus rally. Now we're talking about the January barometer. I mean, I get it, it's fun, right. There's some history there. I'm actually just curious, as a true pro, as a CIO, does that register to you? How much attention do you pay to those things?
What we're paying attention to right now, what our equity team is, did the rotation, and you guys talked about this, did the rotation already take place in December? And now are we starting anew? For instance, as you guys talked about the tech stocks moving today. So it was the last 2 years, the rotation's been in January, and it's been violent. Did it already take place? That's what our equity teams, so that's the first thing on our mind. Then the second thing on our mind is not so much the Santa Claus rally, that came from Yale Hirsch years ago, but now what's earnings season going to do? That's the focus. Our earnings growth, S&P 500, go from 10% last year to 13, 14% this year. That we'll start to get clues to that middle of this month.
And then you talked about productivity at the beginning as one of the 3 Ps too. And I know you're watching sort of the Fed and rates very carefully, and productivity feeds into that. Productivity, we've already seen some gains here. So how do we still squeeze out more in 2025? Do you expect that to continue?
That's where AI comes in, right? Is AI going to make the industrial sector more
Supposed to be
productive, et cetera?
Do you see, John, when you talk about, do you already see effects of AI in that way in boosting productivity growth?
Only in the margins, the legal business, the marketing business, in the margins. It hasn't, in our view, it hasn't come in mainstream yet. But what we're watching, every quarter a productivity number comes out. It's been above 2%. Is it going to stay above 2%? We think that, our economic team thinks that's important to profits. That's how you're going to turn 5% profit growth, or excuse me, revenue growth into 14% earnings growth this year. It's the only way to do it.
And what do you think happens to the yield curve in 2025? I know you're watching that as well. And then sort of what hinges on that for you when it comes back to the other discussions we've been having, whether it's, what happens with profits, et cetera?
No, you're totally right on. So theoretically, in a perfect world, the Fed goes to 390, the 2-year kind of gravitates to 390. Of the last 30 years, the relationship between a 2-year Treasury and a 10-year Treasury has been 1%. So that would put a 10-year at about 490. We're at 460 today. So in our world, is the yield curve going to steepen? Then we become interested in bonds at 490. Stocks aren't going to like it, but we're going to watch now from 460 to 490. What's the yield curve do? Yield curve is going to be very important this year, just as it was last year when we went from inverted for 2.5 years to positive.
John, thanks for coming in.
Thanks for having us.
But we'll see you again, hopefully
Thanks for having us.
John Augustine, Huntington Private Bank CIO.